Welcome back to the Owner Podcast. My name is Dion, and in today's episode, we're taking a little bit of a different route. We've been mainly talking about owner-occupiers, or as if you were looking for yourself. But in today's episode, we'll be discussing investment properties. If you're a first-time investor, if you're considering rent vesting, all those sorts of things, we'll be breaking that down. I have Wayne here. Welcome, mate. How are you?
Very well, thanks, mate.
That's good.
Yourself?
I'm well, mate. Good to have you on. I should also put a quick disclaimer in this podcast that this is general information only and does not constitute financial or investment advice. Always seek a professional before making property investment decisions. Views expressed are our own and not those of any affiliated organisations. But now we've got that all out of the way, mate. We can kind of have a bit of a discussion.
Continue on.
Yeah, exactly right. Continue on. Mate, obviously the market is crazy at the moment. So much is happening. We're hearing all these sorts of things and people saying good time to buy, bad time to buy. You ask 10 different people, they'll tell you 10 different things.
Yep.
But I'd love to hear from your perspective. Like, what are you seeing? You're out there as a buyer's agent. I don't know if I mentioned that before. You are a buyer's agent as well. What are you seeing at the moment?
Yeah, inquiries definitely lifted.
Yep.
Especially over the last sort of 3 months.
Yep.
Melbourne. Investor inquiry over the last 3 years has been great because, but that's predominantly been Perth, Adelaide, Brisbane, regional WA, regional Queensland, but Melbourne is definitely starting to move. And I'm noticing it quite a lot.
I feel like even just on my numbers, on what I'm seeing, it feels like people know the market's not going to explode in the next kind of month or two, but I feel like they're trying to get ahead of it. That's what I feel like I'm seeing. They're like, hey, let's get in early. And even if the property doesn't necessarily grow in the next 3 months, we'd rather get the right property and give ourselves enough time to actually buy something.
For sure.
But that's sort of, I mean, it's hard to know. But obviously in today's episode, we can kind of discuss maybe some different options and we want to unpack investing and break down the basics a little bit. I think that is what people are really wanting. I feel like, and you even said investment inquiries picked up dramatically in the last 3 years. It feels like people are wanting to sort of explore that avenue now that information is more available. Is that what you think?
Yeah, for sure. And I think rent vesting's become quite a popular choice for people because they want to live where they can afford. And rent is a lot cheaper than mortgages in many cases in Melbourne. So popularity with rent vesting is definitely on the increase.
So we went out, I went out for dinner last night with my wife and we went with some friends of ours and that was something that they were even discussing with us, like, hey, rent vesting. They did the whole, like, do we rent out our place? Like they bought an owner occupier, but probably hadn't considered rent vesting, and people maybe listening to this may not have even considered like what is rent vesting and all of that. So maybe we even break it back a little bit. Like what is rent vesting? Like how does that work?
Yeah, so it's basically living and renting where in an area that you want to live in, but you otherwise couldn't afford to buy in. For example, there's plenty of suburbs around Melbourne where entry level for 3-bedroom basic home could be 1.1 million. But rent might be $650 a week. If you were to buy that, it would cost you more than that. So what a lot of people do, well, I love living here, but I can't afford to buy here. But then I'm renting, so I can't afford to save enough cash for a deposit. So if I buy an investment where the growth drivers are really, really good and I'm getting 5.5% yield, it's pretty much paying for itself. Out of pockets aren't great, and then you've got all your tax depreciation and so forth. And they can build their deposit much quicker if they decide to sell it. But some people, they end up going 1, 2, and 3 investments. They might sell one. There's a big chunk of deposit for them. Yes, you'll have to pay some tax on that, but a big chunk of deposit, you couldn't save that fast.
Because I think it's a good way as well to look at that first home, like that a lot of people consider as a stepping stone. So a lot of first home buyers will already go into their first purchase going, this will launch me into my dream home or my family home. So when you're considering it from like an investment perspective or that sort of rent vesting perspective, you're probably going to give yourself a better chance to, I'd say, have that property grow, I'd say at a larger volume than if you purchased in your own backyard. Whereas if you purchase in your own backyard, you're not necessarily making a decision based on growth. You're making a decision based on your emotion.
Spot on.
And that's not necessarily the best thing for an investment property.
Totally agree. Buying for yourself, as you said, is emotional. You're looking for the area like, and friends and family are in the area.
Yeah.
The parks you're well acquainted with and so forth.
Your workplace. I think that's a great thing you mentioned before. So like you're a young professional that lives in one of the inner city suburbs and you're already renting, or you have an apartment, for example, and you're at that stage of life where you're considering having a family, you need to upsize. If you're going to purchase a 3-bedroom house, as you said, a lot of them could be $1 to $1.5 million in that area. You might only be able to borrow $600,000-700,000. So you're in a bit of a tricky spot. You can't move out further, but you want to get into the property market because you know it's moving. This is like that sort of hybrid approach where you can, rent a 3-bedroom place and then you could end up purchasing an investment property. It doesn't even have to be in the same state.
And more often than not, it shouldn't be in the same state because property, different areas have different growth drivers and they're in different parts of the cycle. And I suppose a lot of your listeners will have heard of the property clock. If not, it basically, you have a 12 o'clock right around to 12 o'clock. And so 12 o'clock being the peak of the market, 6 o'clock being the bottom of the market. But many areas around Australia are on the upswing, so between, say, 6 and 12. But there's a lot of areas between 12 and 6 that are actually falling. And Melbourne has been in that category for the last 4 years.
Melbourne's a great example because that's where we both live and the market really hasn't moved at all. If anything, it's come back a little bit. And you look at other places like Perth, Queensland that have been a bit of hot spots really. That's where a lot of money has been going recently. They haven't been falling. They've been rising. So it's a great example on, hey, the property clock is actually different for every different state. And there can also be different markets in states that can be moving at a different.
There's no such thing as an Australian property market. There's so many different markets within markets within markets. And you break it down state by state, suburb by suburb even, and then regions in particular states.
Correct.
You know, capital cities, Perth, for example. I think Perth's getting close to the peak. It's had a great run for 4 years, but regional WA is about a year, 18 months behind Perth. So it's still going okay. Places like Bunbury, Geraldton, great investments, 5.5%, 6% yields and great growth drivers. But Perth, I wouldn't recommend right this minute because I think you're buying really close to the top. You might get 10%, but then you might have 4 years of nothing. Because a lot of people think the property market goes up all the time. Correct. It does not.
Spot on. Whereas if you purchase that, like let's say you live in Perth, right? You're at that stage, on that example, you're a young couple wanting that family, wanting to upsize, and you're like, hey, maybe we need to get into the property market. If you purchased an investment in Perth right now and you've only got 12 months of growth before 4 years potentially of it's staggering and just holding at the same, then you're not going to see the same growth as, let's say, potentially Melbourne I'd say, and we can talk about this a little bit later, maybe anticipating some really strong growth in the next couple of years.
Spot on.
Then you can't necessarily get into that family home as quick if that's the plan you went. If you just based off your investment as, hey, I want to invest where I know in my backyard, that may not just be the best place for you to go. You go to Melbourne and then you can get into your family home quicker.
Perfectly put, So if let's say Perth's got a year to go, it might jump another 10, 15%. But once it hits that 12 o'clock and once it starts to fall, it can drop 2%, 3%, 4% per year for the next 4 years. But over a 4 or 5 year period, it could drop as much as 10%. So it's gone up 15%. You're really happy for the first year, but 5 years later, it's probably down 5%. That hasn't helped you. So if we can pick an area, so I always look at buying in areas that have long-term growth drivers. So the city's growing, population growth, lots of jobs, lots of industry, not one industry towns, lots of infrastructure spending. And it has to be all of those things, long-term growth drivers. But timing the market's very important too, especially for first home buyers, rentvestors wanting to use or even sell that property to use the equity as a deposit. So you want a good 2 to 3 years of solid growth. Well, you'll only get that if you buy in the right time of the cycle.
And that's where, I know you would have heard this as well because I hear this all the time. A buyer comes and has a chat to you, or even you just hear it in conversation. Hey, my friend bought here and they did really well. So I'm basing my investment off that one person's experience. What they may not be factoring in is, hey, that was actually purchased 24, 36 months ago.
Spot on.
And it could have been the absolute perfect decision at that time. It doesn't necessarily mean it would be for you. That same buyer that made the decision 12 months later, it could have been a different area to invest in. 24 months later, it could be even another area to invest in. So just because someone you know has purchased somewhere doesn't necessarily mean that's guaranteed to perform well for you as well.
Because it's outdated.
Exactly. 100%. You spoke about a couple factors before about what pushes price and like what's good drivers for price long term. This is a bit of a simple question, but it's a complex question, one that's probably hard to answer. And what everyone wants to know, what makes a good investment property?
Yeah. So location, first and foremost.
Yeah.
You've got to pick the right location in an area that's growing. It has all the growth drivers that I mentioned just before. You have to have it in the right time of the cycle. So to cut a long story short, I think good location and good yield.
Yeah.
So my favourite line is capital growth is the name of the game.
Yeah.
But cash flow keeps you in the game.
Spot on.
So if you're buying $1 million investment and it's getting $500 a week rent, great. You could have a great capital growth property, but your cash flow isn't wonderful. And then you go to the bank to buy a second investment property and you're tapped out.
Correct.
Your serviceability's no good.
Yeah.
So if you can get that 5.5%, and you can get plenty of areas in Australia that are offering that.
Yeah.
Melbourne's a little bit lower, but it's probably the best it's been for many, many years.
Yeah.
You're getting 4.5, high 4s.
Yeah. Whereas previously it's been like high 3s.
Correct.
Yeah.
Correct.
Yeah.
So great timing for Melbourne. And if you buy the right property and it goes up, 10%, 10%, or even more, then the yield will grow just as quick because rents go up commensurate.
And I think as well, when we talk about good investment purchases, it's great to factor in like asset class as well, because this is something that some people don't consider, like houses versus apartments.
Yeah.
Because they might look at an apartment, which is notoriously going to have a higher yield and could be in a good location, but land underpins value in a lot of markets, and that's where you're going to get your long-term growth, whereas an apartment is a depreciating asset. Yeah.
Spot on. And to get back to your previous question as well, so apartments I probably wouldn't touch.
Yep.
And at the moment, apartments are touted to do really well over the next 2 to 3 years, but I still wouldn't touch them because as soon as it becomes good, they tend to overbuild.
Yeah.
And then you might have had great growth for a couple of years and then you've handed it all back in a short period of time.
Yeah.
So apartments, and I know because over my 30-year journey of investing, I've invested in apartments and they've been my worst investments.
There you go.
And
history has a funny way of repeating itself.
It does.
Yeah.
It does. So I think stay away from apartments. I'd stay away from probably house and land packages.
Yep.
I think the developer makes a lot of money there.
Yeah, exactly.
And there's a lot of hidden costs, and then variations cost a lot of money when you're building.
Yeah, spot on.
What you think you're getting and what you're paying tends to be completely different after you've made a few little changes. Didn't include landscaping.
Yeah, exactly.
Didn't include window coverings. Didn't include this. So I'd stay away from that.
And I think with house and land packages, it's always good to make the point that they're building it on the best land available. And like I know we had this chat the other day on the phone.
Yep.
All the good areas have already been built on.
Yep.
So this is the best of the rest. This isn't necessarily, and as we spoke about before, land underpins value in a lot of markets. So this isn't necessarily, the land isn't going to grow at the same rate as other more blue chip areas. There's no track record of growth. So it's very risky. It may do well. Like you definitely hear about people that do well with land and house and land packages, but the risk level is really high. Like apartments, there are people that say they've done well from apartments, but the risk level is extremely high.
Yeah, 100%. So I would probably recommend, especially for first home or first time investors, something simple, so like residential and low maintenance.
Yep.
So something established but reasonably new, so you're getting very good depreciation. Low maintenance, so maintenance costs are very low. You get yourself a good property manager and you sleep at nights.
Yeah.
For a first-time investor, they shouldn't be looking at development projects or big major renovation projects, of course, unless they want to live in it and do it. Then it's a great plan. But if you just want to rentvest, so you're renting in your own home, or renting a property, and you're
investing that cash. Yep.
You want a simple investment.
Yep.
You want to sleep at nights.
Yeah.
And you want to make money whilst you're sleeping.
Yeah. And as a lot of people even that come to us will say, it's like, hey, I know the first investment sets me up for the other ones to come. So you probably don't want to take a high risk, investment purchase on your first one. I mean, everyone's risk tolerance is different.
Yep.
But I mean, you spoke about as well, first time investors, there will be a lot of first time investors that listen to this and are curious, how much cash or, I know we can't say exactly, everyone's scenario is different.
Yep.
But like, what's the average sort of cash someone would need to get into purchasing their first investment?
Great question. And it differs. So it depends on people's incomes, how much deposit they've got already. So how much cash? Look, I've had some investors, 90% LVR. It's not unusual. 80% is ideal. And then your cash flow is amazing. But, if I'm buying a $600,000 property and then you're talking $120,000 deposit plus costs of say 40. So you're talking 160. It's not easy to save.
Yeah, correct.
So, but 80 plus 40 is a lot easier.
Spot on. So you find probably that first time investor has less cash.
Yep.
But the further they go, they normally are able to put a higher amount of money to each other property. Is that what you're saying? Yeah, cool.
Correct.
Nice. Yeah.
And then even if it's 90% LVR, you let time do its thing. Over 2 or 3 years, if we buy in the right spot, that might drop down to about 65% LVR.
Yeah, exactly.
And then you're pulling out some equity to buy your next property. You're not having to save cash again.
Yep, exactly. And you've spoken about a couple of things as well before, but like rental yield versus capital growth. What matters more? What do you think matters more? I mean, they both have their pros and cons, and you can't have like really one without the other. You want to have a kind of a balance of both. But what do you think matters more?
Yeah, really good question, because a lot of people say, no, it's all about capital growth.
Yeah.
And it is. So the first and foremost, you must have capital growth.
Yep.
That's the name of the game. But I would sacrifice a tiny bit of capital growth for a much better yield so you can then build on your portfolio.
Yep.
So because you can buy one property, your cash flow is really good. Let's say it gets 15% growth in a boom time. That's not unusual for a particular area, but there might be another area that's getting 20%, but the yield is much lower. I would take the 15% with the higher yield. A couple of years of that, you've got your deposit for your next property, and the bank will lend you money because your cash flow, your income is higher. Yeah.
Whereas if you bought the one that has 20% growth, although that on paper may look better, they may not be able to get into their next one because their rental yield's less.
Spot on.
Yeah.
And I always tend, when I'm helping an investor, I always try to set them up that they don't buy one and they're done.
Yeah.
I really try to set them up so they can build a portfolio.
Yeah.
Which is really what they should be doing if they're going to get into property investment.
When I know we spoke about property clock before, but this will be a question a lot of first-time investors will be asking: is now a good time to buy?
Yeah, another good question. So now is always a good time to buy, in my opinion.
Yeah.
It's just where.
Yeah, exactly. Because as we said, different markets. And there's this saying, time in the market beats timing the market.
Correct. A little bit of timing
Yep.
To pick the location, but it's only timing toward location.
Yeah.
So to answer that question properly, as soon as you've got either equity in one of your properties or you've saved up enough cash for your second investment property or an investment property, now is always the best time, because there's always an area or location somewhere in Australia that's booming.
Yeah. And the timing is more about where you're buying, whereas buying now, like as in like time in the market, that is always now. So that's exactly right. It's like you got to pick the right market, even if, let's say, for example, you're going to consider purchasing in Melbourne and you considered 4 years ago. When we say time in the market always beats time in the market, you have to pick the right market, which is where it comes back to. You have to be able to time the market you purchase at. But that's why you'd go to an expert that would say, like, hey, here's my recommendation based on, growth factors and whatnot. We'll break this into 2 episodes because I felt there's a lot to still unpack, but we want to make sure we also condense it enough for people to listen to. So we'll come back next week with part 2. We'll follow up on some more questions that first-time buyers or first-time investors are curious to know about. Wayne, appreciate your time. We'll see you next week.
Welcome, mate.